Welcome to part two of our Being Credit Ready webinar at the Glenn Jones Group and Coldwell Banker Access Realty. If you haven't seen part one, I highly encourage you to go back and watch it on our YouTube page. We have Patrick Cirone, am I getting better? From Mortgage Ready, who explained a lot of information about how credit scores are calculated and figured and algorithms. And he called it being a credit nerd, I believe was his term. So I think we all a little bit better about that now. So just to recap, we have here Austin Amick and Adam Hart from Bank South. And then we have Julie and Chris, real estate agents with Coldwell Banker Access Realty and the Glenn Jones Real Estate Group. So someone decides to purchase a home. This is open up to all you guys because we go through this as realtors, because I'm a realtor as well. You know, we get somebody, they see a property, they call, first thing they want to do is go look at it. And usually, I would say most real estate is, Julie, Chris, we try not to ask how you're going to pay for it, but how are you going to pay for it? You know, I mean, you got to know that at some point. Are you writing a check? Are you borrowing money? So someone decides to buy a home. What should their first step be besides calling a realtor? Or we put them with these guys? Do they talk to the lender? Do they kind of look at their credit report? Where if they kind of know they have good credit, where do they go first? Adam or Austin, you can probably take this one.
Yeah, I would say you always want to get in touch with a lender in the very beginning of the process, because if you go out and you check credit, your own credit, and you look at it, as Patrick was saying on the first clip, there's all kinds of different algorithms out there. And the ones that are important are the ones that the lenders are going to use. And the lender's going to pull your credit for you. So the first place you want to go is to the lender, sit down with them or talk to them in today's environment over Skype or Zoom or just over the phone, and just tell them what you're trying to do. No matter your level of knowledge, whether you're an expert and it's your sixth purchase or you've never done it before, don't be scared to go sit down with a lender and kind of just let them see everything and know what's out there, because our job is to kind of direct you and guide you based on all of the information. So, you know, one thing I would say, sometimes people will hold certain things back because either they're embarrassed by it or they think it's going to cause them problems. Don't ever do that. Just expose everything and let them know everything that's going on. As a lender, we'll then pull the credit report, and good, bad, or indifferent, we can go over that report with you, give, you know, some advice on it. And as Patrick said, if need be, we partner with Patrick, and he's kind of the expert on that credit. You know, it's important too, because you may be looking at a house you can't afford, or you could afford a bigger house. So, you know, getting with a lender initially kind of puts you in the ballpark and the range and the knowledge of where you want to be based on down payment, debt ratios, credit scores. And you just leave a lot out there, a lot of variables that could help you have a better interest rate or a better scenario. So definitely start there, and a good lender will partner with your agent. So
I'm sure you've run into an experience where you've had somebody that, you know, wanted to go see a house at, you know, say a $250,000 house, and they were lucky to buy a $125,000 house. Have you been in a situation like that? Either Julie or Chris, one of y'all?
Yeah, and actually on the flip side, I showed a house for around $100,000 to someone who, you know, I recommended that they get in touch with the lender, because we would need a pre-approval letter in this market, or a pre-qualification letter, because things are being sold so fast. And they actually got in touch with the lender and found out they qualified for a lot more than they thought they were qualified for. So, you know, it can work either way. Really, the bottom line is you need to get in touch with the lender and find out what you're dealing with, so that as realtors, we can better serve you and know what area.
And I would refer everybody, if if you're watching this and new to real estate, this is some great information we're sharing today. Go back and watch our first couple of webinars we did. Our last one was called Game of Loans, and Adam and Austin both participated in that. We talked a lot about different kind of loan programs that are out there that are available to people that we didn't even know about. We had some non-traditional ones. And we also did one for first-time home buyers. That was one of our early on webinars we did that was full of great information. All those are posted on our YouTube channel, which is the Glenn Jones Group, Coldwell Banker Access Realty on YouTube. And then we also have them all on our blog at homegradersavannah.com. And we'll show you that at the end, where you can find all that. So I would encourage everybody, if you're starting this process, because we take you through it step by step with a lot of good information. Minimum score to buy a credit, to buy a mortgage? Is there a minimum score? I mean, is there like a cut and dry, or is it kind of all over the place depending on the program you get?
There's not necessarily a cut and dry. It is all across the board based on the product, the program, and the lender. Some lenders are different than other lenders. We are a 640 credit score on government and a 620 on conventional. A lot of times we'll run into a 629 that needs to go government, and we can look at it and do a rescore on the credit based on a small credit card pay down on balance. I had a client that had a 702 and they had $1,100 on it, and they're going to pay that card down to $250, and their score is going to most likely go above 740. And they can do that pretty quickly. If it's not a quick fix, we can then also partner with like Patrick and his team and work on a little bit longer. But it varies. I'd say you're kind of standard across the board in today's environment is that 620 mark. 620 to 640. Most lenders aren't really dabbling below 620 in the current environment.
The only thing that I would add to that is the higher your score, the more options you're going to have. So it kind of will open up. For example, I had a guy who had a 700. He was looking to do a refinance. He wanted to take cash out, but his rate was not very good with a cash out. He has 700 credit. So I said, hey, dude, pay this off, pay this off. I sent him over to Chelsea at Mortgage Ready. She got him up to a 740 within, I think, like 3 months, not even that long of a time. And he was able to do a cash out at a much better interest rate. So it just opens up more options if you get your credit up higher. So we want to get you the best rate at the same time to save you money. So we don't get paid by giving you a higher rate or anything like that. So it really is just a better if you get your score as high as you possibly can with the amount of funds you have available.
And this kind of goes back probably in the first part, but Patrick's still here, so we'll get it. And you guys probably running this too. I know driving around Savannah, I see little signs on the corner that say, we'll fix your credit in 30 days or 60 days for, $100 or whatever. Which anybody that would buy something off of a sign like that should have their head examined anyway, in my personal opinion. But then you see, even I think it's Equifax or Experian or one of them will, like, they tell you they have TV commercials that say they'll boost your credit score with utility bills and rent and stuff like that. That just sounds preposterous to me. Am I thinking that right, Patrick?
Yeah. So Experian Boost is a product where it's completely free for the customer. Mm-hmm. They designed a web application to go onto your bank software. So whether you have Wells Fargo, Chase, whoever you have, they're going to go onto your software. They're going to pull out every single transaction you've had for the last 2 years. Mm-hmm. That's where the value is. They want all of your information. But what they do then is they post these installment accounts, which again, that's not the type of account that I would recommend to risk score. I would always recommend a revolving account. They post these installment accounts, and the length of these credit histories are generally only 12 months. And so I've got probably 7 or 8 credit reports sitting on my desk in the office. Every single one of those Experian Boost lowered score by lowering length of credit history. Wow. Actually harmed their score. Wow. Like, hey, your Experian's 40 points lower than every other bureau. Did you know why that is? Because your length of credit history has been depressed by all these brand new utility accounts. And there's like 10 of them. You've got like internet and your cell phone and like all this stuff. It can really hurt your score. So I would say be very careful about, like you said, the numbers on the telephone poles are absolutely ludicrous. There are laws that we have to obey. We have to obey all federal law, all state law. The Attorney General of the state of Colorado actually just went through all of our business practices and gave us the big stamp of approval. Right. And those phone numbers on those telephone poles, you get what you get. If they were any good at what they do, we wouldn't be putting a number there.
You should never hire anybody from a telephone pole unless it's somebody to cut your grass, maybe.
Maybe.
Yeah, that's about the extent of that. Come on.
I'm kind of a DIYer in most things myself.
There.
But with things like credit, you don't know. You could do a lot of harm. And really in the home buying process, I do meet some DIYers and they wind up spending a lot of money and creating a whole lot of pain for themselves.
Patrick, quick question for you, because you hit on something I was going to ask in our prior session. We're talking about when Austin was talking, you said keep the card open that he opened originally.
Yes.
You run into a lot of people that follow different. They'll go from Capital One to American Express to Visa because they get better points or whatever, and they'll close that.
Pointsguy.com, right?
Right. And they'll close out an old account to open a new one, and they've always paid on time, but that can have an adverse effect on your credit, correct?
Oh, absolutely. And so when you open up a new account, that lowers your length of credit history. If you close an old account, that also lowers your length of credit history. And you want to stay above about 5 years of average credit history if you want to stay above that 740, 760 mark. If you drop below that, you might get like a free ticket to Maui or something, but you're going to pay too much for your home, your car, your insurance, everything else in your life. These credit card companies, they're not charities. They're not giving you away anything for free. They know what they're doing. And when they kind of entice you into those deals, it does depress your score, and they wind up charging you more in interest in the long run.
Yeah, and we didn't mention this, and I had this term written down, but the reason why credit cards are so important is the term for credit cards is called unsecured debt, and everybody needs to think about that. And that's why they're so important to your credit scores, because there's nothing really tied to them as far as, physical. Like they can repossess your house, you can repossess your car, so there's security there. So that's why credit cards are rated so high. Is that true, Patrick? I mean, it's because it sees how you manage that payment with that unsecured debt.
The why that's a deep question as to the why. You'd have to ask Mr. Fair and Mr. Isaac as to the actual why. But that does make sense what you're saying, because it's one of those things where if you are on the ragged edge of being able to afford your lifestyle, your credit cards are going to be maxed out. That makes sense. But you will not be paying your car loan late, because as you said, it's secured. You're going to get it. That makes absolute sense. But knowing that these credit cards are so highly weighted, knowing that is power. Because now we know to not buy things on credit cards. We know just to charge up literally $1, the smallest amount that you can possibly charge every single month, so that we raise our credit score as high as possible. That saves us money on our installment loan, our mortgage, our loan.
And definitely don't. So, I mean, I was always under the impression that you closed them. Hey, if you're not using this for a long time, like my Best Buy that I haven't used in 2 years, we talked about in the first one. I mean, I've been tempted several times to close it, but I never have. I mean, and I won't now for sure, because I probably had that card for 20 years. Yeah. So I definitely don't want to damage my.
It's completely unique. So let's say your Best Buy card you had used twice ever, and you reactivated it. You'd be reactivating a young account, and that could actually lower your credit score, right? But I had a customer come to me that went from a 680 to below a 630 because she hadn't been to Macy's in 6 months. Literally, all the good payments she had made were no longer in consideration by the algorithm that determined the score, because she hadn't used it in 6 months. And all she had to do was go in and buy that little bar of Godiva chocolate at the register for about $1. The date refresh, she went back up to 680. Some of this credit is simple and elegant. Other pieces of it are extremely complicated.
Great. So, hey, Adam or Austin, when y'all send somebody to Mortgage Ready, I mean, are y'all looking 3 months? I know everybody's a little bit different. Every case is different. So please, when you folks out there watching this, this is general stuff we're talking about here. Everybody's program is going to be a little bit different. So, keep that in mind, because everybody's credit score is a different number and there's a different amount of debt and things going on. So how long do y'all typically see somebody, go from entering the program to being ready?
So you want to go, Adam?
Go ahead. I'll follow you. Go ahead.
So I sent a guy over to Chelsea, who Chelsea, by the way, when I keep mentioning her, she is one of the credit experts over there at Credit Analyst that works for or with Patrick. So they came to me around Christmas time, first-time home buyers. Their scores were somewhere in the 540s, 550s, all three of them. Just had some collections and some high balances. And I sent them to Chelsea. She put an estimated pool date on there for me. I want to say May. So from the time that we started to the time that I actually went and pulled their credit again, about 5 months. We closed on a house with them in June. Went from 540 to 640 in basically 5.5 months. Yeah, I know. And so, and one thing that I will say is the reason we send, and you brought up the signs on the lamppost. The reason we send people to Patrick and Chelsea is because we actually see it works. It's usually way cheaper than anybody else to send it to. So, I mean, I know that it works. I've seen it work. I send everybody to them because I know that I can, if they follow their plan, I will have clients in 6 months. With the cash out guy that went from 700 to 740, only took him 3 months. Now, if you've got a 480, it might take a little bit longer, but they're still going to give me an estimated pool date. They're still going to keep me in touch. Chelsea sends me a long list of updates every month on each client. So it really depends on, I guess,
Yeah.
where your credit's at to start with. So, and then Adam,
I mean, I imagine 540 is pretty low. Like you said, even be attempted to buy a mortgage.
Right.
When you give people this, I mean, if you can get them in 5 or 6 months, I imagine you could really help somebody with a 600, 610. You could really move them pretty quick in the process.
Yeah, and I was just gonna,
let me jump in here. Sometimes yes, sometimes no. And that's why that analysis is critical.
Absolutely.
When we take a look at a file, we'll tell a customer, are they looking at 2 or 3 months? Are they looking at 4 to 6, 5 to 6? We like to set those expectations because we want them to know exactly what they're getting into. We don't want them to start code that they're not ultimately going to finish. And we've been doing this a very long time. And so our estimates are fairly accurate.
Great. Adam?
yeah, I was just going to say, and it's kind of piggyback on why you go to a mortgage lender to then go work with Patrick and the team is we'll pull the credit report and we don't charge you for the credit report. And then if there's small quick repairs, we can still do those and you can possibly still close in the next 30 to 60 days. However, if not, what we do from that stage is we'll sort of tee up Patrick and his team and just say, we've got these people we partner with. I'd love to send over, we can pull down a consumer credit report that's shareable with Patrick and his team, no cost to the buyer. And we'll send that to our client and say, hey, please reach out to and give the information to the account rep on Patrick's team that they would be working with and say, and like in Austin's case, it'd be Chelsea, and say, hey, here's the contact information for Chelsea. Here's your consumer credit report that's specific to mortgage lending. Please call them and then give them a copy of the credit report, and they'll go over a brief synopsis with you that makes sense. And by the time you listen to them, you'll want to buy into the program because, again, like Austin said, 540 to 640, bought a house, probably got a really good rate as well. It cost them, $600 over the course of 5 months to do that. So.
You can imagine how much they'd be thrown away in terms of rent. I mean, how much are they paying in rent? Sign a 12-month lease, it's a no-brainer.
Yeah.
You definitely help people. I love it.
I'll give Austin some props. He's working with one of our group agents, Spurge Rutland, about putting a lot of renters. We deal with a lot of renters, and I didn't even know they were doing it. I just found out about it recently, and y'all got some folks in there that are getting close, correct?
Me and Spurge and Chelsea have a pipeline that we go through, and I talk to Spurge multiple times a week, and I talk to Chelsea multiple times a week, and we are, sending people through there, and we should. Again, it's all people, and I can tell this with Patrick, if you don't have success, you didn't follow your plan, because everybody that I've had follow their plan has absolutely had success, 100%. So, but we should have some people that are going to be coming out hopefully in the next month or so that are going to be able to make offers on houses. They had the income, they had the down payment, they just didn't have the credit score. Now that they have the credit score, we're ready to make an offer on a house. So.
Let me just get on my soapbox here for a second. Being in this business, I think every one of us, from all of our different angles, and we're talking to everybody out there, not just these guys, is our goal, and we like nothing happier than getting people to buy a house. That's the American dream, is to own a house.
Yep.
And to have your own piece of land and not renting. I grew up with a single parent. We never lived in that. We rented and moved around a lot, and it was something special for me when I bought my first house. And that's part of the reason I love real estate is, you own that piece of dirt all the way to the core of the earth and up to the air and infinity. We learn in real estate school. There's just something special about that. And not even mentioning the financial aspects of it, because you're making somebody else rich. Some of the richest people I know are landowners that rent their property out. You out there, the renters, are making them rich. Stop it. Make yourself rich. Make yourself money. You're going to save money in taxes. I told you I get on my soapbox about it. So, but don't feel bad. You talk to people, and nothing makes us happier when we find somebody that thinks they're hopeless of not being able to buy a house. There's down payment assistance programs. These guys on the bottom, they're on the bottom of mine, Adam and Austin, and every mortgage lender that we work with, they're great at finding ways around. And something y'all don't know, I don't know about Patrick, but the rest of us, we don't get paid unless we sell y'all mortgages and sell y'all homes. So that's a benefit to us as well. But that's why we're so motivated, is because we like to see y'all live in the American dream. Corny, but true.
Everybody's on the customer side. You guys want it to be successful. And me, I want it to be successful or my business goes away.
Yes.
If I don't work, guess what?
So don't think, if you're out there and you think, oh, my credit's terrible, I can't buy a house. Well, we can fix that. Don't think that I have down payment and I can't buy a house. because if you can pay rent, especially in Savannah, Georgia, because rent is through the roof, you can darn sure buy a house because most of the time your house payment's going to be way cheaper than your. Believe me, we all see rental prices out there. It's crazy. You know, people are paying $1,400 a month to rent a $150,000 house that they could probably buy for $1,000 a month, right, Austin? Close on numbers there, you know.
Well, your landlord wants to make a profit on his that he has on it. So he's got, if he's going to do it, if he's in it for the money, which, you know, is what they do for a living, if their mortgage is $1,200, they're not going to charge it $900, right? I mean, they want to make their money. It's not a, you know, it's not a charity. people have to make their money too. So
please go back and watch our other webinars. Like I talked about our first time home buyers webinar we did, our game of loans. Call a realtor. It doesn't have to be a Glenn Jones Group realtor, although we're the best that there ever was. Call one of us, you know, call Adam or Austin, and we will help you through every step of the process. I mean, we all have stories. I'm sure Julie's got stories. Chris has stories. I do, you know, of people that we took and got from, you know, nothing to be able to buy a house. So, all right, let's see. We got a little bit of time left here. Go through a couple more things. We always talk about, I used to hear the myth, and this is kind of probably a Patrick or even you guys, about bankruptcies and foreclosures and things like that. You know, it used to be 7 years they used to say was like the norm. Is that still kind of the case, or?
Kind of sort of the case. Everything is supposed to fall off in 7 years unless it is a bankruptcy or a account that's related to bankruptcy, then it can stay on for 10 years. Anything you see in public records, so tax liens, judgments, bankruptcy, typically those are around for a decade if you don't do anything about them. It's pretty easy to delete, believe it or not. Public records are not the hardest thing in the world to delete. But if you don't do anything about them, public records.
But if you have a bankruptcy, you're pretty much dead in the water for a little while before you can buy a house again.
You absolutely are. Yeah. So don't believe any credit repair person that says they could delete the public record.
Thank you. That's exactly why I asked.
And get you into a home. No, that would never work. And that's why you can trust Mortgage Ready. We're not just credit repair.
Yeah. Because I see that on my little. I see that on the telephone poles at the corner. You know, we'll fix bankruptcies, and I'm like,
I mean, Fannie, go ahead, Adam.
Go ahead.
Fannie Mae and Freddie Mac. I mean, they have. You cannot get a conventional loan until, I believe, 7 years until the discharge date. Now, that's on foreclosure. On the bankruptcies, it depends on what type of bankruptcy. You know, Chapter 7 versus Chapter 13. Chapter 7, and correct me if I'm wrong, Chapter 7 is the one where you can have a plan. You just put your hands up and say, I surrender.
Yeah.
Chapter 13 is the one where, hey, you know, I've got a plan in place. I'm making my payments. I believe conventional loans, that's 4 years from the discharge date. Government loans, it could be maybe 2 years. You got to have a thumbs up from the court that did it. But Chapter 7, I believe, is like 4 years from the discharge date, and you have to have thumbs up regardless of what kind of loan program. So
yeah,
that's correct. It's 4-2.
Yeah.
And these customers, though, that are in a Chapter 13 bankruptcy, they need to start working on their positive credit, period.
Right.
The trustee of their bankruptcy will not allow them to open up new accounts or take on new debt unless they're able to really sell that trustee on why it's best for them and why it is not new debt. People that are in a Chapter 13 bankruptcy, excuse me, we recommend a secured credit card where they give a few $100s to the bank. The bank holds that as a security deposit, and then they open up a credit card with that exact amount as their limit. It's not debt at all because the deposit secures the account. It's not debt at all. But it's very important that customers, when they have a bankruptcy, what really hurts them is not the public record that says bankruptcy. I mean, that's what they're embarrassed about. That's what they feel terrible about. But what hurt them was the fact that they lost all of the positive accounts. And so getting positive, paid as agreed accounts started up immediately is mission critical. You know, so when I say, yeah, you can't buy a house for 2 years, that doesn't mean just, you know, put your feet up on the desk and wait 2 years and then see a loan officer. Go talk to a loan officer right away. Be strategic about it so that at month 24, rates are low, you can pull the trigger.
So bankruptcy should be last resort. And I know people have to do it. I know things happen, but it really should be a last resort it's kind of a nuclear option. There's no coming back from it for a while. So one of the things as realtors, and I think Julie and Chris will probably agree with me 100% on this, is it kind of drives us crazy a little bit sometimes with buyers. They get them pre-approved by one lender, whoever it's going to be, their bank they use, Quicken Loans, or whatever place they get it. And we talk to them and try to get them to, let's shop you around a little bit, because there's better deals to be had out there as far as interest rates. And we love working with local guys like Adam in Austin and some other folks we have. Oh no, I don't want my credit to get checked again. I don't want my credit to get checked again. That inquiry is going to hurt me. It's going to hurt me. Can you guys kind of clear that up where we are with that? Because it kind of makes me crazy. I got to be honest. So y'all run into that, Julie and Chris?
Yeah.
With clients?
Actually, I don't want my credit pulled again. Yeah.
So
Do you want me to jump in, or who? I'd be happy to.
Patrick, go ahead.
Okay, cool. So mortgage pricing typically happens every 20 points. And so pulling credit can hurt your score, but it's very rare that you're going to drop below a pricing tier. And if you do, the original credit is still good. And so people say there's a shopping period within the mortgage industry. It's 14 days, it's 45 days. I'm sure that's exactly what's driving you crazy, because nobody gives you a straight answer, right? The straight answer is this. There's really no shopping period in the mortgage industry. Each time you pull, it will most likely lower your score. There's only one exception. That is if your loan officer uses the exact same company to pull credit as the last company. In that case, you're going to see the scores be exactly the same, because the first company will pay money to the bureaus, and then the second loan officer will pull, and they'll just sell with the same credit report to the second loan officer. They won't actually pull again. So in that case, you'll see scores being the same. But normally we'll see it drop just 2 or 3 points each time per pull. I will say though, shopping alone, honestly, and I'm in the industry, I buy real estate all the time. I don't do that. I really don't. I have somebody that I trust. And I know that this is a huge decision. All kinds of things can go wrong. My brother went to one of those big online companies to buy a house in San Francisco, and he went to the closing table and nobody showed up. So really, trust is key. This isn't like, buying something. Right?
Well, and that's what I always explain to clients. It's not, I don't care who you use, but I want to do the best product for you, not just cost wise, but, I know Austin and Adam and some other guys we work with, they'll give them their cell phone number. They can call them. You can't talk, you go sell them the call signer in the queue for 20 minutes to try to talk to somebody quick, and it's not going to be the same person you talked to a week ago. More than likely, it's going to be somebody else. Or you can pick up the phone and call one of these guys directly. So that's the part that I always tell them. It's not so much the product itself, because they're all pretty similar and they're governed. And I know the costs are a little bit different, but everything's pretty much similar. But it's the service level that I try to sell.
And that's a great point from both of y'all. If somebody goes out and shops their rate, most likely they're going to save at the most an 8 from one lender to another lender in interest rate. But go to somebody you know and you trust, or your agent refers you to that they know and trust, because you got a financing contingency. You've got a bunch of money up in the air on that contingency. There's a lot of people out there that just smoke and mirrors an interest rate and say they can do it and not really do the research into it. And then you get 20 days of your contingency, and they're saying, "Look, we can't do the loan anymore." And the $2,500 in earnest money you had's gone. So that's why Patrick's 100% correct. In the same way, I bought and sold real estate. I would only go to certain people. So.
I agree. Well, we're kind of coming to the end of our time here, and I think we had some great information that we brought out today, and I'm sure there's probably could have gone for another hour covering credit, because it's such a complex topic, but I feel like we've all learned a little bit about it today. Julie, Chris, do y'all have any questions for these guys before we wrap things up here? Or?
I don't have any questions. I did want to say, though, that whenever I've had clients that use larger banks as opposed to somebody who's local, I've got nothing bad to say about either one. It's just that the larger bank, you'll be working with somebody who's in another state, possibly a different time zone. And while the company is licensed in Georgia, that person doesn't live in Georgia. But if you work with someone local, they're going to be, they shop at the same grocery store you do. They're in the same weather climate. They know exactly what the market is, and they pay attention. They know where you're moving, and they know tricks of the trade, and they know exactly how many days. Like I was working with Austin, and I said how many days, and he said 35. the banker is going to, for the big bank is going to tell you 30 days, and then you have to pull out all these other stops and do amendments to stuff. So
Yeah.
definitely working with someone local who's in your market that you're buying in is a huge, huge bonus for you.
I agree. Chris, you got anything?
Yeah, I mean, I think I get so many times people they're just afraid to talk to somebody. I think the main point is you just need to ask. You need to call a lender, talk to them. If you can't do anything right now, they can help you. They can fix it. You just can't be afraid to, especially in this market with the interest rates so low. You can get a loan for less than what you're renting for, like you already pointed out. And then people are just afraid to even approach it. And if you would just talk to somebody, I tell people all the time, call a lender. There's no cost. There's no obligation. They can point you in the right direction and, let you know yes or no. And it's worth a call to find out if you can be a homeowner versus a renter. And there's so much more value in buying a home.
Absolutely. My previous career, before I got into real estate, our founder was always famous. He had a famous saying. It said he was begin, the rest is easy. And that's true. If you think about it, anything we try to do, going to the gym, getting up out of the bed and driving to the gym is the hardest part of it. Once you're there, it's pretty easy after that. So just begin the process of buying a home and call an agent, call a lender. There's some great realtors. Call us at the Lynn Jones Group. We have connections with great lenders like Adam and Austin. And if you don't like the way they look, we got some other people too that you might like. Those guys are great. And we'll get you on the right track. Please visit, like I said, our website, homesofgreatersavannah.com. We have all of our websites are on there. We have a YouTube channel that's Caldwell Banker Access Realty Lynn Jones Group, Twitter at Greater Homes, Facebook at Homes of Greater Savannah. All of it's on the screen right now. All of our previous blogs are on our YouTube channel, or on the all of our previous webinars are on the YouTube channel. And visit our blog for some great information on there from our agents. We put up weekly on our website. And feel free to give us a call. Thanks everyone for participating.